A lot of people come to me and ask about this question: should they be a sole trader or a limited company on their journey? Amortization, bit of a difficult one to say that. Let's go over to the whiteboard and have a look at the pros and cons of sole trader versus limited company. So we're going to talk about the sole trader first of all. So sole trader, basically what happens with a sole trader is if you, in the UK, if you want to go self-employed and set up your own business, you have two avenues. You can either set up a limited company or you can be a sole trader. A sole trader is where you as a person are trading basically. So you will be responsible for doing your own tax return. So some of the pros of being a sole trader are literally you keep all of the profits. So if you make £100,000, okay, that is yours to keep. It's in your own bank account. You probably have a business one, but it's your own bank account and that's it. Then the next thing is administration of a sole trader is extremely simple. So your accountancy costs are far less because you are literally talking about a bank account which does some income coming in and some money being spent, and you run everything through that bank account. So if you're, say, a builder or a plumber and you go to a builder's merchant, you buy your plumbing gear or electrical gear or whatever building construction costs, you run that through that, and at the end of the year you've made £200,000 turnover, you spent £100,000 on materials and running costs, vans, all that kind of stuff. So your profit is £100,000 and that is what you will pay tax on. So it can be tax efficient for businesses with lower profits, I would say. So tax efficient, tax for lower profits, so lower profits. What I mean by that is that when we come on to the limited company, you'll see that the more you earn through a limited company, the more tax efficient it is. So this is really going to suit your kind of handyman, sole trader, singular type businesses, where maybe you might have one or two staff, that sort of thing, and basically you're not turning over loads of money, so you're not going to have all of the need for the expenses of the extra accountancy and various other things that need to be done with this kind of setup of a limited company. So tax efficient, but only really if you have lower profits. So the other thing is that your first year in your trading, but only your first year, you can take any losses. So in your first year, you might, I don't know, spend a load of money on vans and set up costs and all the rest of it. You can then apply that to your tax account. So when you do your tax return, you can say, well, I actually made a loss this year, so therefore I don't owe any tax, and you can carry that loss forward. I can't give you accountancy advice. You need to see your own accountant for that, but there are lots of tax deductible allowances that you can carry forward. So that's a really good way. And I think that this sole trader thing is a little bit underestimated. It's perfect for your kind of smaller business when you're first starting out. And it really does suit that kind of 1 to maybe 3 or 4 employees, especially your kind of building industry and the rest of it. But as you'll see in a minute, we'll come on to the benefits of a limited company, and then we'll look at some pros and cons. So here we are, we're going to talk about limited companies, so LTD for short in the UK. So the pros of a limited company really are separation of you and the business activities. So with a limited company, things like debts, for instance. So let's say you go, you're the builder that we're using as an example, and they go and rack up £4,000 worth of material costs at the local builder's merchant, and then your customer does a runner and they don't pay you. So you've now got this £4,000 in a sole trader. You're liable for that personally. In a limited company, it limits you by the liability of the company. So it protects you from debtors and things like that. So therefore your personal assets are protected. So you're protected from the debts, means you're protected from that. So your home that you live in can't be taken away from you, whereas in a sole trader, they could possibly come after you, especially if you have a big claim, if someone falls off a ladder or something like that. You can take advantage of dividends. So this is a tax advantage. So when you draw money out of the company, you pay a slightly lower rate. The company will pay 20% tax. Sometimes it will go up to 25%, depending on your profit. There's a marginal rate in between there. And this does change in the UK from time to time. But generally speaking, it'll be between 20 and 25 for most people that this video is aimed at. And you will be able to take out that as a singular person at a rate currently of 7.5%. Okay, so if you add those two together, it's 27.5% tax that you're paying, and that will be lower than the personal tax rate that you'll be paying once you include national insurance and the rest of it, especially when you go through that 40% bracket. This does go up to a whopping 32.5% when you go higher from your earnings, but the beauty of this is you don't have to draw the money out. So if you only need £45,000 a year to live on, then you just draw £45,000 in it. You leave the rest of the money in the business and it's ring fenced. You pay this tax, but not this tax because you haven't drawn out. So the other thing is clients. There's this perceived thing with clients that limited companies are more established. They can see on Companies House who the directors are. They can actually see who, your profit and loss and things like that. So from a client point of view, it is generally typically regarded as more stable having a limited company than dealing with a person directly. The other thing is you can have shareholders. So you could make your business partner, who might be your wife or somebody else in your family or whoever, a shareholder of the company, which means you can chew up their allowance as well. So with a sole trader, you can't share those particular profits with people. With a company, you can set up shareholdings, which means, say, if you and your wife run the company, maybe she does the books and you do the, marketing or kind of physical work or whatever, I don't know. You can actually issue her shareholdings, so 50-50 shareholding ownership, and then you can utilise their dividend tax allowance. So you'll be able to both draw out up to the £50,000 at this 7.5% rate. And then the other big thing is that you can put into your pensions any contribution you like, which will come off of your bottom line. So pension contributions actually are like a tax deductible expense to a limited company, whereas with a sole trader, they are not a tax deductible expense. You put the money in, the government give you back the tax that you would have paid on it, but it's all retrospective, whereas this is live. At the moment you spend it, it's like a tax deductible expense. So those are the pros of both your sole trader and your limited company. So what we do back now is we'll just flip back round to the sole trader here, and I'm going to use the green pen so you know where we got, and we'll look at some of the cons of that. So this £100,000 here that we've earned, the issue is that you're going to have to pay a mixture of 20% and 40% tax on that. I know you get your tax-free allowance of about £12,000 or something before you have to pay any of that, but you're going to have to pay that, okay? So you're going to lose a lot of that because you have to declare it, because it's actually in your profit and loss sheet. You can't avoid it, you have to report it, okay? Accountancy costs here, yes, they are lower. They are simpler. You don't generally have to use bits of software. You can do. I mean, I would advise anybody with a business turning over more than about 40 grand a year, you get something like Xero or Sage. Other bits of software are available. And here, your accountancy costs are perceived to be lower, but I think those particular costs are not that much different in the end, actually. You may get, when you're small and you've just only got a few transactions, then you might even be able to do this yourself. Whereas if you've got to do a proper set of formal accounts and report to Companies House, you're going to have to use an accountant. So I don't think these accountancy costs are as great a saving as you think. I think they're more cost neutral. They can be slightly lower, but it really depends on your exact setup and how big you are. If you get too big, I think these accountancy costs are going to actually cost you more because you're inefficient by not using a software and doing all those sort of things. So tax efficiency, lower profits. So basically what we mean here was that you can be tax efficient with this because obviously you're paying these marginal rates. But I think this only applies if you have lower profits. You go back to the dividends that I referred to earlier. The bigger the company gets, the more you're going to have to draw out of it and pay this 40% tax bracket. And in fact, actually, if you go over 100,000, so 100,000 to, I think it's 125 now because they lowered the limit. There's a limit between here and here where you have to actually pay back the tax-free allowance on the £12,500 that you got right at the beginning of this. So the marginal rate between here and here, because after this it's then 45%, okay, but the marginal rate between here and here, 125, is a whopping 60% tax because you're having to pay back this £12,500, you're having to pay 20% tax on that. So you're adding your 20 and your 40 together in that zone there until you've paid your 12.5 tax-free allowance back. So if you're a pretty big high earner, but as a sole trader, in my opinion, I think you're missing a trick here because you could be putting your money back into pensions, you could be putting it back into the business, you could be leaving it there for when you fall on hard times, all that kind of stuff. Unless you are somebody that needs £150,000 or something a year to live on, I don't think most people need that kind of money to live on, generally speaking. Or if you do, you're someone that's earning millions anyway, so therefore this is not really for you. So this lower profits, I think that is a perceived thing, and it's definitely akin to your kind of smaller person who is maybe earning less than £40,000 a year or something. Then sole trader is probably more suitable for them. And these tax deductions in the first year, the con with that is that yes, you can claim that, but you can kind of claim tax deductible allowances. And I would hope that if you're a sole trader, after the first year, you're not making a loss. This isn't a business where you're investing loads of money into it, because if you're pumping it full of machinery and tools from day one, you need to be setting up a limited company, because then you can have an asset list and those things are depreciated. You can get the VAT back and all those sort of things. So to say like it's an advantage in your first year, I think that's a little bit of a red herring, more aimed at your very small businesses where maybe in the first year they probably just didn't realise they were going to not turn over quite so much money. So we'll flip on over to the cons of the limited company. So debtors, yes, whilst you can claim those debtors, you might have entered into a thing called a PG, or a personal guarantee. So, for example, if you do property, for instance, or take a loan or something like that, often the person lending you the money, the mortgage company or whatever, will ask you to enter into a personal guarantee, which means that if the company doesn't pay it, they can come after you. So, I try to avoid these personally. At any moment I can get away with it, but there are just some things where you can't get away with it. Generally things like mortgages and stuff like that. They want to know that if your company goes bust, they can come after you, your kids, your house, whatever. Personal guarantee will often be required if you are borrowing money. It generally won't be required if you're opening an account with a builder's merchant or a photocopying company or something like that. There won't be too many of those there at all. And the problem with the personal guarantee is, as I say, they can come after your personal assets. So try and avoid these if possible. I think you will never avoid all of them all of the time. And there's a school of thought which I prefer really, that if you need to do a personal guarantee and you're borrowing some money or you're doing something, if you believe it's going to work and you've done the numbers and you've done the figures, it shouldn't really be any issue you entering to a personal guarantee. One of the stages that I find personal guarantees come up, which is not property and not doing with a builder's merchant or a supplier, is when you're acquiring or doing acquisitions, because often the owner will say, we'd like you to enter into a personal guarantee for two things. One is they want me to enter into one because they want to know that if my company that's buying it, because it might be an SPV, so a special purchase vehicle, my company that's owning it, if that goes bust or I wind it up, are they going to get their money? Because if we agree we're going to pay half now and half in 2 years' time, are they ever going to see the other half? So they sometimes ask me if I enter into a personal guarantee. What we do is we don't give a personal guarantee. We have a holding company which sits above any of these limited companies that are referred to at the beginning of the video. And we say that the holding company will effectively give the personal guarantee. So it gives them the opportunity, if we decide to wind that company up, to go after the holding company, but not me personally. Dividends and tax. Obviously the con of that is you get this 32.5% tax when you get up to the magic 40% tax hold, which is about 50k in the UK. Plus your company is always going to have to pay 20 to 25% tax. So you have to add those back together, and that is a lot of tax. But believe it or not, that is still less than if you're in a PAYE job or sole trader pulling out that money, because you might be paying 40% tax rate, but as you go up through the marginal rates, you get that 60% tax rate, you get national insurance contributions. There's a whole calculation on that. There's loads and loads of tools on the internet that actually you can just literally stick in how much you want to draw out, how much you want to pay yourself, how much you're going to leave in the pot, whether you're a sole trader, limited company, all those kind of things, and it will just work all of this out for you and work out the best thing for you. So there's no point in me working out everyone's individual things, already giving you an example. Go and find one of those tools on the internet, there's loads of them, really easy to use. But this here is something that you have to watch when you're pulling out these dividends, basically. And the other thing is dividends. If you've got shareholders, for instance, if you award yourself £1,000 dividend, it's a £2,000 dividend or a £500 one to you, so it should be equal to the shareholders. Dividends are declared at a shareholder meeting. If there are 2 or 3 or 5 shareholders, then if you declare a dividend of £5,000 and there's 5 of you, it's £1,000 each. That should be documented, and then it goes into your personal tax return that you do when you submit that over to the government. So you've got this. You just need to be wary of all of these various tax rates, because a lot of people get excited by the fact, oh, I've only got to pay 7.5%. Well, don't forget the company has to pay 20%. One of the things I personally find is a real advantage of all of this is that actually this rate here, so this 7.5 and this 32, that will be due in January as part of my personal tax return, whereas this here is actually due in August. So effectively for me, it lessens the burden of finding all of that money all at once in, say, January or August in any one particular year. Clients, sometimes people say, it's nice to know I can go straight to that person. It's not a PG, it's not a limited company, and not hiding behind it. I think, in my own personal opinion, those kind of days are over. I think most people like a limited company. They can go on Companies House, they can have a look at who the directors are, they can see the profit and loss, they can see the company's solvent and trading, and they've got assets and the rest of it. You can't see any of that if you're a sole trader. So with the clients thing, and it's a lovely, good pro for them that they can find out all that information, but actually that's also a con as well, because it means that people can look you up on Companies House. You can hide your personal address, but Companies House need that. So if you're not careful, then people can actually see where you live and they can come around to your house and pester you. All of this is in the public domain. Your accounts might get scrutinised. So like if we're going to enter into a big contract of say £200,000 worth of work with a builder at Charles Cox. Before we instruct them, we may just do a little bit of due diligence and make sure they're not about to go bust and they've got some assets and their accounts have been submitted and so on. So you can see all of that. So it's a pro and a con. I think if you're a legitimate business and you do your accounts properly and the rest of it, even if you go, well, we made a bit of a loss last year or our accounts don't look too rosy, as long as you understand why that is. For example, for us, we have the holding company that I referred to before. So you've got Charles Cox Group, which is the holding company, and that holds various LTDs all down like this. Okay, so you've got LTD. I won't give you all the names. You can look those up if you want to. That's the whole very point of me talking about this particular topic. You'll find that the accounts for this one, they might break even. This one, so let's say we make zero profit here. Here we've made, I don't know, £100,000. Here we've made £25,000, and here we've made a loss of £50,000, and then over here we made another profit of £100,000. All of these things are actually fed up into the group here, profit-wise or loss-wise. So you need to look at these sets of accounts, not at these ones, in order to see the true position of the firm. Shareholders, obviously this is really good, but you can make this super complicated. You could have A and B shareholders. Sometimes they're got different dividend rights, they've got different voting rights and the rest of it. So that's a pro and a con, because you can make it overly complicated, and also you can protect yourself from tax, or you can burden yourself with tax. So you have to be a little bit careful with what you're doing here. Take some specialist advice. Make sure that you're doing the right thing and you set it up. Like, make sure that you've prepared for the day when you might pass over to children or something, that they don't have a massive benefit in kind tax because you've just gifted them the shares of your company or whatever. And obviously you need to keep a record of this as well. So there is slight increased cost with this, because you have to do a return to say, we're the shareholders, this is who we are, and these are the kind of A and B options and the rest of it. And then pensions here, obviously, in theory, this is brilliant because you can just stick the money straight in, it's tax deductible and it's very straightforward. But with a sole trader, if you pay money to the government, then you can claim back the tax that you will have eventually have paid. It's just that this is a much easier process to follow in most people's eyes. It's just simply classed as a tax deductible expense, whereas if you go back to the sole trader, it is literally, you've got like your £100,000 that you've made, and then you're gonna have to put 20 grand of that into a pension. You're going to get the tax that you would have paid on that back from the government. So you're going to have to pay the tax over and then claim it back. So a slightly different way of doing things. So hopefully you've really enjoyed that. Hopefully I've given you some really good key takeaways from there. There are lots and lots of reasons, pros and cons for these things, but if you've watched it this far, you obviously really did enjoy it. So please just do us a favour, do one of those three things: like, subscribe, comment. That will really help us get this video and the other ones out to a wider audience, help more entrepreneurs on their journey and reaching their goals.